Brand new properties can be a fantastic investment. They're modern, obviously, they're low maintenance, they are attractive to tenants. But there is a catch many investors overlook, and that is oversupply. Even in today's generally undersupply housing market, if you buy in the wrong pocket, you could face longer vacancies, rent discounting, and sluggish capital growth. Let's unpack what oversupply really means, how to spot the red flags early, and how to choose a location where your new build stands out instead of blending into a sea of for rent signs. Hello everybody, are you ready to make smarter property investment decisions? I am Kate Hill, Qualified Property Investment Advisor, and I am here to help you cut through all the noise with honest, no hype advice. Real strategies, real tips, zero fluff. Today I am asking and discussing how we avoid getting into areas that are oversupplied with rental properties. So oversupply happens when there are more properties available than there are tenants or buyers to fill them or buy them. It's common in a very rapidly developing suburb where thousands of new builds go up at once within a relatively short time, but infrastructure, jobs, population growth does not keep pace. In an oversupplied market, rent and sales prices stagnate or drop. Vacancy periods stretch out. You might have to offer incentives just to secure a tenant. And when you do go to sell, buyers see too many identical properties and very little reason to pay a premium for your property. So some large estates, they look great on paper, you know, the brochures, the wide streets, brand new homes, glossy marketing. But if they're all investment stock and tenant demand does not match supply, you will be competing against hundreds of other landlords for the same renters. And don't even get me started on rent guarantees. So these might sound reassuring, but they can be a real red flag, especially in oversupplied or off-the-plan markets, which is mainly when you see them. They're often used to mask poor rental demand, artificially inflate yields, prop up inflated purchase prices. And once the guarantee period ends, you are going to be left with a property that cannot achieve the same rent or attract tenants easily in the real market. Be cautious of suburbs that had a building boom 5 years ago, but little growth since then. Sometimes the hype fades, demand stalls, investors are left holding a very shiny new but underperforming asset. Check local vacancy rates. Anything under 1.5% is tight. Way over 3% may raise a bit of a red flag. Look at trend lines over time, not just the current figure. A rising vacancy rate can mean trouble ahead. Development application, otherwise known as DAs, and building approvals are key. If thousands of homes are planned and you don't see matching infrastructure, growing jobs, or growing population, then that is a warning sign. More supply on the horizon can undercut your returns. You want a suburb with, obviously, growing demand from renters and owner-occupiers. Owner-occupiers stabilise an area, they reduce turnover, they keep values steady. Check who is buying. Is it investors only? Is it a good healthy mix? Population growth without jobs growth, that creates a churn. Focus on locations that are near hospitals, universities, industrial zones, transport hubs. These areas attract long-term tenants and they reduce vacancy risk, even in new estates. Not every new build area is oversupplied, but ignoring the warning signs can cost you. By doing your homework, reading beyond those glossy brochures and focusing on demand-backed suburbs, you can invest in a new build that performs now and well into the future. Avoid the trap and build your portfolio the smart way. As always, everyone, thank you for watching. Please subscribe, I do appreciate it. And I will chat to you all soon. Bye.